I'm Caroline Hyde. This is Bloomberg Technology. Coming up, a packed hour of tech earnings ahead with Alphabet, Microsoft and Intel all reporting after the bell. We'll fill you in on the rosy outlooks and the big misses. Plus, creating the biggest power couple in wireless space. We'll break down the secret meeting between the CEOs of Verizon and Liberty and the consolidation race in the industry. And after the 2016 private equity explosion in Silicon Valley, we'll get the lay of the land for 2017 from the co-head of tech from Permira. First, to our lead. Alphabet reporting fourth quarter profit that trailed estimates. If you look inside the Bloomberg, shares dipping in extended trading. Go to GIPA. You can see those sorts of moves. Earnings per share fell short of expectations, but that's due to an increase in the tax rate. Alphabet posted a 22% tax rate growth during the quarter. That's up from 5% last year. However, there were a few bright spots. The company continues its stronghold on advertising, beating analyst expectations on paid clicks, up 36%, and narrowing slightly its operating loss for the Other Bets division. Joining me to break down all the numbers is Bob O'Donnell, President of Technalysis Research, and Adam Berke, President of Adroll. Gentlemen, welcome to the show. Can you give us first, Bob, a bit of an overview here? Because there's a lot to wade through. Operating income and revenue both up more than 20%, but everyone's focusing on the earnings per share and the spend.
Well, you know, you have to take a step back. Here's a company that makes massive amounts of money, has massive levels of growth, and yet, yeah, people are finding those little areas. You know, the problem is always about expectations here. And, you know, obviously we'll talk more about this, but the ad ratio, the click numbers, you know, the amount per click is clearly a challenge for them. But what's good is we're seeing them spending money on some of these other bets that I think will pay off in the long run. In the short term, sure, there's a lot of extra money being spent, but I think they have a number of very interesting opportunities. I mean, Google recognizes that they have to extend, or Alphabet, pardon me, has to extend beyond, you know, the advertising business model. And these bets, slowly but surely, are going to start to pay off. And I think we're starting to see some of those signs of spending in those areas that we'll see growth later.
We'll dig into those in a moment. Let's dig into the advertising revenue element with you, Adam, because I'm seeing cost per click falling, 15% this time round, but they're still managing to lure in more people to buy those adverts. They're going up about 36%. Is it a worry that people aren't paying up for each click so much?
Well, to a degree, the declining cost per click is a continuation of the trend that we would expect as people move to mobile. Conversion rates are still lower on mobile devices, so therefore the advertisers that are marketing those businesses are less inclined to pay up for clicks that happen on mobile devices. So that's all more or less to be expected. I think the bigger question is around the click metric in general. Yeah. We're hearing from a lot of our customers that they're sort of starting to question how valuable are clicks overall.
Explain that, because you don't have to click on ads anymore.
Right, well, I mean, especially, you know, so obviously the search engine is Google's cash cow and has been for some time, and the default behavior for an ad on a search engine is to click it and to click all those blue links. In YouTube, it's very different. You're viewing an ad, and so that could be a very good thing for Google. You're opening up to a whole new range of use cases, a whole new range of different verticals. You don't tend to click convert to buy laundry soap, for example, unless you're shopping on Amazon. So that can open up a CPG category and things like that. But the whole click metric is going to end up getting a lot of noise the bigger and the more important YouTube gets as a share of the total.
Talking to that, interesting, we're just hearing from Sundar Pichai, of course, CEO of the Google element of the business, and he is saying that key trends powering Google at the moment, machine learning, three biggest bets, YouTube is their first one, cloud and hardware. Let's dig in with you, Bob, a little bit more about the cloud and the hardware. I was impressed. Cloud, they say, is their fastest growing area of the business, but they got tough competition when you're looking at Amazon and Microsoft. Well,
they do, and of course, Microsoft also showed big growth in their Azure business. So, but look, it's a very large area. There's a lot of opportunity for everybody. This is definitely a case of, you know, raise all boats kind of thing. And so I think we'll see Google continue to expand that cloud business, and as they can start to leverage some of their machine learning, some of their AI kind of capabilities, integrate that into their cloud offering, that offers a great way for them to differentiate somewhat from both what Microsoft and Amazon are doing. Now, both of those companies are doing that as well, but each one has their own special sauce and special flavor. And then on the Other Bets side, I mean, look, this is a company that is heartily dependent on one area. And for a lot of people, it does raise some concerns long term, like, well, how long can they possibly sustain that? So let's look at what they're doing. they spent a lot of money advertising the Pixel, right? That's part of the reason why those costs were so high.
$3 billion.
But we've all seen the ads now, right? It's a nice piece of hardware. Google Home looks like a very nice piece of hardware. They've got Daydream on the VR side. There's a number of very interesting areas that they're starting on. They're going to take a while, but they're clearly laying a foundation to do some nice growth in hardware and additional services on top of that hardware.
And back to the YouTube element of the business, you think this could actually become the powerhouse going forward, do you? I mean, when does it start to show its dominance? Because they don't really break it out for us.
Yeah, I mean, I absolutely think it's a huge opportunity, and I think where people actually get it somewhat wrong or diminish the opportunity is thinking of it simply as TV dollars moving to online video, and that's not all it is. It's actually a growing the pie scenario, because there are all sorts of businesses where the owner maybe has an iPhone 7 and can create a quick video and then promote that on YouTube and Facebook, for example.
Google would hope it might be a Pixel.
Yes, exactly, yeah. But that's an example of an advertiser who never would have bought a TV ad. So sure, all of those TV ads are likely going to move towards digital over time, where consumers are spending time on YouTube, so that's all great. And it also opens up a whole new set of demand because of the lower friction and lower barrier to entry for digital video.
Fascinating. I wish we could spend longer talking about all of this. Adam, it's been great having you. Adam Berke, president of Adroll, and Bob O'Donnell of Technalysis Research. You're sticking with me. Now, another story we're watching. Shares of Charter popped in trading. Bloomberg News reporting that Verizon CEO Lowell McAdam approached the chief executive of Liberty Media about a possible combination with Liberty's Charter Communications. Verizon closed down over 1% on the news, while other wireless carriers like T-Mobile and Sprint edged up in Thursday trading. We'll dig into the consolidation between cable and wireless providers later in the show. Coming up next, though, our coverage of the major tech earnings rolling on with Microsoft. The boost it's receiving from Azure. We'll break it all down. This is Bloomberg. Welcome back. Now, Ant Financial is expanding its international reach. The Chinese financial technology company, controlled by billionaire Jack Ma, is buying US money transfer service MoneyGram International for a whopping $880 million. Now, the deal comes at an opportune time for MoneyGram, since a substantial portion of its business could come under pressure from the new US administration. White House spokesman Sean Spicer told reporters Thursday that President Trump may call for a 20% tax on imports from Mexico. The announcement comes after Mexico's President Enrique Peña Nieto reaffirmed that they will not pay for a border wall. Trump previously said he would also consider halting money transfers to Mexico, which represents about 10% of MoneyGram transactions. Now let's dive back into those earnings. Microsoft's second quarter sales and profit exceeding analyst projections, bolstered by rising customer sign-ups for Azure and Office Cloud computing services. Shares up in extended trading when you're looking at the Bloomberg. It's the first earnings report for Microsoft since the company completed its $26 billion purchase of LinkedIn. Joining now is Bloomberg editor-at-large Corey Johnson, and still with us, Technalysis president Bob O'Donnell. Let's kick off with Microsoft, because generally, relative beat across the board, and it is cloud that's powering the way, Bob.
Yeah, absolutely. I mean, the Azure business continues to grow for them, nearly doubled. And, you know, there's no sign of that slowing down. There's a huge opportunity out there, as we discussed briefly before, Amazon, Google, and Microsoft all driving this business. A lot of interest there. And we're seeing each of these vendors, and Microsoft in particular, trying to focus on adding some interesting artificial intelligence, speech recognition capabilities, so that other developers can take advantage of this on if they're going to use Microsoft's cloud services. So we're going to see a lot more exciting developments in that area. The Office 365 business is very interesting as well, because they've successfully moved from this model where we all used to pay, you know, for a copy of Office to now where we pay a subscription. And in the long run, that obviously has some nice financial benefits. So we're starting to see some of the opportunities that they're driving from that as well. And interestingly enough, even the Windows business did okay.
That old chestnut.
Yeah, that old chestnut still actually had some opportunity. And then, of course, they're heavily involved with gaming. That's a hot area as well. So they're nicely positioned, I think, as we move forward.
Something that the CEO has put into play. But what about the acquisition, LinkedIn, Corey? Did we get any hints as to how that's going to start being adding to earnings per share?
How will be linked to other results? They're very much separate businesses now. The question is, how long is that going to be the case? Microsoft, more than almost any other company that has survived, has screwed up merger after merger after merger after merger going back decades. So can this one be any different? Of course, they certainly hope so. Their plan is to keep this as a very separately operated company. So the results, of course, in the first quarter that it's consolidated is going to be separate. But the question is, how much linked is it going to be in the future upon fully intended?
Well, the one thing I would, just to jump in briefly, is that with Office 365, there is a very interesting mix between some of the LinkedIn capabilities with Office. As you tie contact information from Outlook and other things into LinkedIn, that seems like a reasonable mix. So we'll see what happens. But
more sales potential there. What about Intel? Because I know you've been all over these earnings today, Corey.
Intel results are really interesting because, with all the companies we're talking about today, right? Microsoft, Alphabet, Intel, we're talking about this seismic change in computing of moving from companies buying lots of equipment to companies borrowing equipment and doing it over the cloud.
Yeah.
And so what you saw from the Intel results is Intel trying to wrestle with that issue, where they have this fantastically profitable business. As the PC industry is contracting, their server business also very profitable, trying to move into a lower margin environment where they're going to have Internet of Things, more modems, more memory. So when I talked to the CEO, Ian King and I, our terrific semiconductor reporter, we got on the phone with the chief financial officer, and what he had to say to us about the PC market was interesting, because Intel saw rising sales into a shrinking market with PCs. So he said, as we enter the year, we've got a somewhat cautious view for the PC TAM, for the total addressable market. In other words, they expect PCs to continue to contract, and they're worried about that. But at the same time, they think that their data center business might be strong. So when they look at the ways that, how can they guide towards basically flat margins and some and growth that's still growing, as they sell in a shrinking industry, that's by selling better stuff into data centers and by trying to keep those margins together on the other side. So when he said we expect ASP to performance, the average selling price to be a little bit better for all of their products as they bring new products for the data center business. Then he looks down market though and says, but at the same time, we're looking at higher growth for low margin products of memory modem. So they'll have more low margin, which will have to hurt their high margin business on the data center side. Slightly
what we saw with Alphabet, that they're just having to sell yet more adverts as the cost per click goes down. Bob, weigh in here. I mean, it's interesting because, of course, Intel could do rather well in the problems of Qualcomm at the moment.
Adverts are ads, by the way.
Yes, no,
from the...
I did get that, but thank you.
Lost in translation.
But yeah, no, absolutely. So the modem opportunity for Intel is clearly there. Intel is kind of like Google in a way, in the sense, like Corey said, they've been focused on a very profitable business. They've had to deal with the other bets business much earlier than the other folks have. So they obviously have data center, but they've made big investments in automotive now. They're making big investments in IoT, in Altera with FPGAs, other kinds of processors. So they're really spreading their bets. And even in PCs, the interesting thing is, yes, people are buying less of them, but the ones they are buying are more expensive.
And that Altera business is very interesting, too.
It is, absolutely.
It puts them in a very different place in the world of networking
yes,
they haven't been. So, when I talked about distributed computing on the cloud, well, networking is so important that Altera business that will help put them in those boxes is a big deal for them.
Yeah, exactly. I mean, we're seeing this evolution of the data center from a semiconductor perspective, and Intel's recognizing we can't just sell the CPU, we've got to have these other pieces.
Right.
And that's what they're starting to bring in. And oh, by the way, some of those pieces play very nicely in automotive, they play very nicely in IoT, and other areas where there's a lot of interest and excitement. Like I said, that's why I see them becoming a much broader company as well.
Thus far, trading after hours, they're completely flat. So not quite got the excitement of you two, but thank you for bringing it to life, both of you. That, of course, was Bloomberg editor-at-large Corey Johnson and Technalysis president Bob O'Donnell. Coming up, Verizon targets Charter Communications. Could this potential tie-up help Verizon keep pace with rival AT&T? This is Bloomberg. More consolidation in the wireless broadband industry could be ahead. Verizon CEO Lowell McAdam approached Liberty Media CEO Greg Maffei about a possible combination with Liberty Charter Communications. That's according to people familiar with the matter. Now, the combined entity would create the largest internet provider in the US. Let's take a look at the possible deal. A combination of Verizon and Charter wouldn't be a merger, it would be a mega merger. And it's not the first one we've seen recently, like AT&T's $109 billion bid for Time Warner, and Charter's own recent moves acquiring Time Warner Cable and Bright House Networks last year. Now valued at $103 billion, those acquisitions made Charter the second largest cable operator in the US, just behind Comcast. Currently, Verizon is the #1 mobile carrier and #2 telecommunications provider, but the company has been facing a slowdown in its core wireless business. This proposed deal would bring together thousands of miles of fiber optic internet capacity at a time of soaring demand for faster broadband. A tempting asset as the industry gets more saturated and consumers cut the cord. Quite a bit of information to go through on this potential tie-up. Joining us from New York is Walter Piecyk, who covers telecom, media and tech sector for BTIG and has a neutral rating on Verizon. Welcome to the show, Walter. Thank you for your time. And Verizon numbers, as we saw this week, weren't looking too pretty in terms of the earnings. Would this tie-up be helpful? Would Charter cure their ills?
Well, the tie-up with Charter wouldn't cure the ills of the wireless business, which is having some issues. Their competitors are offering unlimited plans, and Verizon has resisted that, probably because they have 100 million customers, and it's unclear if the network could handle that type of usage. So buying Charter, and people have talked about some of the fiber that they have and adding 5G, that's in a section of the market. It's unclear how high quality the assets are that Charter has that would enable 5G versus perhaps Comcast, who has much better, I think, fiber investments have made historically. So it doesn't really shore up anything. It just kind of adds a different business and one that obviously generates its own free cash flow.
I think what's interesting here is we're starting to see perhaps a division in the ranks of what the best tactic is for the future. You've got AT&T and Time Warner saying content is king, and here we seem to see a deal that wants the infrastructure, but you're saying the infrastructure isn't really up to much.
Well, for a while, the CEO of Verizon, Lowell McAdams' strategy was go all wireless, and they were shedding a lot of this fixed stuff. And then all of a sudden, you have this issue where maybe wireless is not the best thing or the only thing for them to do. So there seems like there's a lot of pressure on the company in order to make some type of changing transaction for them. I think your own Bloomberg's own Alex Sherman talked today about them looking at 10 companies. That makes a lot of sense to us, where basically they've got issues in the wireless business. There's a whole host of companies that they're looking at. And now, with the new administration, there tends to be this anything goes mentality where you can really perceive of any type of transaction at this point, it seems like, right?
Maybe not an AT&T Time Warner one, if we're to believe Trump for the time being. But what about the 10 other companies that Verizon could be looking at? Who would be a good fit in your point of view?
Well, if they're interested in fiber, then Zayo, which has 116,000 fiber route miles, would make a lot more sense. If they want to actually fix their wireless business or have enough capacity and hurt T-Mobile's ability to get capacity, then they should buy Dish. If they want to get content, maybe they should look at Disney. If they want to diversify the slowing business that they have and get more slowing businesses and more diverse, maybe they should look at Vodafone. I mean, there's so many different options that I think Verizon could look at going forward here. The fact that they're talking to Charter is I think it's interesting. It's not really surprising given the challenges that they face. And the bigger question then is for Comcast. If we are in an anything goes environment, why shouldn't Comcast also be looking at Charter? And maybe this whole conversation with Liberty is just Liberty saying to Comcast, hey, why don't you guys come and take a look at us before this spectrum auction is over, and really all these deals start to gather some pace.
So regulatory hurdles, are you foreseeing fewer for amid this new administration, or is the land not quite clear yet?
The land is not clear. Look, DOJ theoretically should have major issues with a Sprint T-Mobile transaction, and yet the market seems to think with great confidence that transaction can get done. On the FCC side of things, with Ajit Pai as our new chairman of the FCC, I think the perception is probably rightly that there's not going to be as much problem with transactions or the FCC using the power they have to evaluate these things based on the public interest. But look, the DOJ is a methodical type of organization, so we're skeptical that if Sprint T-Mobile actually tried it, that they'd be successful. But hey, look, if we're wrong and the market's right, then again, why shouldn't Comcast be looking at Charter right now? So
is there one bet to be placed on, and that's on the growing excitement of M&A bankers in telecoms and media. Is this the way it's going to go? More M&A for 2017?
I mean, 2017, it seems like all of these companies are gearing up. And again, Zayo is interesting on the fiber side. But the one company that seems to benefit in all of this is T-Mobile. I mean, T-Mobile is unaffiliated. They're controlled by Deutsche Telekom. There are a variety of bidders that would be interested in that T-Mobile asset. And certainly if T-Mobile got bought, that would have positive implications for Dish, because Dish has a lot of that spectrum, which is good capacity that T-Mobile could use to continue that a growth trajectory that's really just unmatched in the world right now as far as revenue growth and EBITDA growth. No one's really growing faster than T-Mobile right now.
Yeah, and don't AT&T and the likes know it. Walter Piecyk, analyst at BTIG, thank you so much for your time.
Thanks for having me.
Now, coming up, Alphabet shares plunging nearly 3% in after-hours trading. We'll talk to Google veteran Ben Legg about what's working and what's not for the tech giant. And Bloomberg News, check us out on the radio. You can now listen on Bloomberg Radio app, Bloomberg.com, and in the US on SiriusXM. This is Bloomberg.
I'm Elisa Parenti, and you're watching Bloomberg Technology. Let's begin with a check of your first word news. UK Prime Minister Theresa May embraced President Trump as a friend and an ally, but cautioned him not to turn his back on global institutions and long-established political values. May spoke in Philadelphia on her first official visit to the U.S. Tomorrow, she becomes the first foreign leader to meet with Trump since the inauguration. Hungary's PM says there is an opportunity for the EU to adopt reforms to, quote, make Europe great again. Viktor Orban, an early Trump supporter, spoke at a conference in Brussels saying it's high time to take the U.S. president seriously. Orban also called for the EU to negotiate a new bilateral trade deal with the U.S. French presidential candidate François Fillon says he would step out of the race if charged by national prosecutors investigating an allegedly fake job held by his wife. Fillon said there's been nothing improper or illegal about employing his wife as his parliamentary aide for years. 14 people with suspected ties to Islamic State were detained in early morning raids on Thursday. That is according to Australian officials. They also say suspects were being investigated for attempts to try to set up a parallel society in Australia. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Elisa Parenti. This is Bloomberg. It is just after 5:30 p.m. here in New York, 9:30 Friday morning in Sydney, and we're going to have a look later with Paul Allen. That's going to come up later in Bloomberg Technology. Thank you.
Hi, my name's Ashley.
Hello, Ashley. I am a socially intelligent robot.
Ashley Vance is going to the farthest corners of Earth.
This is the UFO.
What am I gonna find inside? You get Wi-Fi out here?
To find the mad scientists, the tech geniuses, and the dreamers of tomorrow.
It's about high-tech innovation and doing really, really clever things.
Hello, world. Friday on Bloomberg.
I'm Caroline Hyde. This is Bloomberg Technology. Let's take a look at our top story for the hour, tech earnings. Alphabet, Intel, Microsoft, all reporting results after the close. As you can see, Alphabet currently under some pressure, down 2.2% in after-hours trading. Profit missed analyst estimates after the internet giant spent heavily to market a slate of new consumer hardware. But Alphabet CEO Sundar Pichai telling investors on the call that early sales numbers of Google's latest products, well, they're encouraging.
We're thrilled with the reception, as well as the really happy customers we saw over the holiday season. In particular, Google Home was a very popular present that many people opened on Christmas morning. We are committed to this for the long term as a great way to bring a beautiful, seamless Google experience to people. The early signs are promising, and you can expect us to see us expand our offerings thoughtfully.
Let's continue our discussion on Alphabet's results. I want to bring in someone that knows the company inside and out. Ben Legg is the CEO of digital advertising firm AdParlor. He's also a Google veteran, previously serving as Chief Operating Officer of Google Europe and Google UK. Welcome to the show. Thank you for joining us, Ben. And first of all, the numbers as you see them, the spending that they're making, do you think these are positive steps that will have rewards eventually?
I think they're spending money on a lot of stuff. So clearly they talked about marketing of hardware, but there's a part of Alphabet called Other Bets. And Other Bets is losing about $4 billion a year on all sorts of bets, from fiber, driverless cars, life sciences. And I think analysts and investors are wondering which of them will pay off and when, because if none of them do, then Google's or Alphabet's wasting $4 billion a year.
YouTube seems to be something that the company is bigging up a lot. That and cloud showing significant growth. Where do you think YouTube could go?
I think YouTube will probably be the biggest driver of Alphabet's revenue and profits, I think, for the next 2 or 3 years. So clearly it's in a good space. It's digital video, and as TV audiences decline and people cut cords and advertisers still want to interact with consumers with a video, YouTube's in a really good spot. It's a good spot for a few reasons. Firstly, I think it's dramatically underpriced. When we look at like-for-like pricing of YouTube versus TV, YouTube is probably about half the price that it could be, even with how it is now. But on top of that, they're growing their inventory, the number of people watching videos, and they're planning, or they should be planning, to launch all sorts of new ad units and targeting opportunities, which will also drive prices up and volume up. In addition to which, they've actually signed a deal with CBS, and they're talking about other deals to bring things like live NFL games to YouTube. You add all that together, YouTube is fighting for a very large share of the global TV advertising market, which is a $200 billion market. So if Google could get, say, 20% share of that, which is not impossible, that could make it a $40 billion business in the next few years.
Wow, I mean, we had a guest on earlier, Adam Berke from Adroll, who was saying maybe we shouldn't be looking at cost per click as a metric anymore. I'm looking at cost per click falling even more, down 15% for Google overall, but we are seeing more people piling in and buying ads with Google. Yeah. Should we, if YouTube's going to be such a big player?
Well, I think cost per click's been a red herring forever. So there's actually 3 drivers of the drop in cost per click, and none of them are necessarily worrying. There is the move from desktop to mobile, and in general, in the categories where Google makes a lot of their money, like insurance or e-commerce, conversion rates on mobile are lower, and therefore clicks are lower. That's slightly worrying, but there are solutions to that. But another 2 big reasons for CPCs to drop is there's more and more clicks in developing countries where GDP is lower, so click prices are lower. And there's also a lot more clicks on branded queries, people searching for a brand, and when that happens, the clicks are cheaper. So there's actually 3 drivers of lower cost per click. 2 out of 3 are red herrings that had nothing to do with Google losing any momentum. When it comes to desktop versus mobile, Google does have a potential issue. They need to work out how to make money in mobile. But to be frank, Facebook's worked it out, and Google should be able to work it out. Facebook prices are actually higher than Google prices, and they've got a whole clear roadmap of what they've done to get there. And quite frankly, Google should, to a large extent, copy Facebook.
I want to talk a little bit more about Facebook with you, because I know you're a man who helps brands connect with not just the likes of YouTube, but also Facebook, Pinterest, many. But Facebook today had the interesting news that they've just hired Hugo Barra. He's coming back from Xiaomi. He's going to be joining to do the VR and AR element. And they're talking big once again. This is the next big platform, major computing platform, so says Facebook. VR and AR, do you agree?
I'm on the fence, and if I had to pick one side or the other, I think it might be a red herring. I think this might be the start of Facebook going down the route that Google and Alphabet have gone down of making lots of interesting bets that may not pay off. I hate to say never, but when I think about the potential uses down the road, I see all sorts of uses for gaming, for training, for all sorts of wonderful things, but not to be a massive part of people's lives that can shift the needle in terms of revenue. And don't forget, Facebook's already close to a $30 billion company. Can VR and AR make a meaningful difference to Facebook's revenue? I'm not so sure.
And I've got to bring it up on a day where we see sort of international relations being taken on the Twitter platform between Mexico and the United States. How are your clients looking to engage with Twitter at the moment? Is Donald Trump accessing his clients, his user base in the right sort of way? And where's Twitter's future in your view?
Yeah, Twitter, so for advertisers' thoughts around Twitter are quite pragmatic. Twitter has a large audience, they have good ad units, they have good targeting, and so there are very few advertisers stopping spending on Twitter. I think Twitter's battle is really defining who it is in a world full of social networks. Snapchat's up and coming, Instagram's up and coming, and saying what do we stand for and who are we, and really just getting its mojo back, because with all the other exciting things going on, it's easy for new advertisers to not get around to spending on Twitter because there's always a newer, shinier object like, say, Snapchat or Pinterest or Instagram that just is a bit more exciting than Twitter. So I think Twitter still has a bit of an identity crisis, but advertisers aren't running away. A big audience and good ad units means good revenue.
Legg, CEO of AdParlor, great conversation. Thank you for whisking us through many a social media platform. Thank you for joining. Now back to the other top story in tech. Verizon is eyeing Charter, a merger that would lead to the US's biggest internet provider. President Trump has repeatedly criticized AT&T and Time Warner for their proposed merger, saying too much power would be in too few hands. Well, while this could be seen as true, AT&T and Time Warner do not compete with one another. Verizon and Charter do. Bloomberg Gadfly's Tara LaChapelle calls it a pipe dream, literally. She joins us now. Great story. People have got to go onto Gadfly and see your police. But talk to us about why this is indeed a pipe dream from a regulatory perspective.
So from a regulatory perspective, it's funny because if you look at AT&T and Time Warner, obviously Donald Trump has admonished that merger many times on Twitter and in speeches. And he says, like you said, the power would be in too few hands, but they don't compete with each other. Then you have Verizon and Charter reportedly maybe considering a merger, and here are two companies that do play in the same sandbox, and that would potentially be problematic from a regulatory perspective under a normal situation. But this is, abnormal times. We don't really know what to expect, and I think the perception right now in the media industry and telecom is that the Republicans and the Trump administration are going to be a lot more open to letting these companies get bigger and get stronger if it doesn't involve a lot of job losses. And I don't know if that would be the case with Verizon and Charter, but I think that people are at least perceiving this administration as more open to the idea. But it's funny because if they think that that deal can go through, then certainly you would think that AT&T Time Warner should be able to go through. So it kind of throws a wrench in what he's been saying all this time. And I think a lot of that too isn't necessarily because he thinks the AT&T Time Warner deal would be inherently bad for consumers, but I think a lot of it has to do with the politics of it, because obviously Time Warner owns CNN, and he's just not a big fan of the media right now.
You don't say. We're just seeing the share pop that we saw in Charter Communications there. You're saying what potentially the consumers might or might not get out of it. What about the shareholders?
So it's really hard to say, because when we look at some of these mega mergers, the math usually doesn't work right away. I mean, if you just run rough numbers on Verizon and Charter, the deal would be dilutive, which means that it wouldn't add to the company's earnings. In fact, it would hurt their earnings because it's such a big, expensive deal. So that means that you then have to rely on a lot of synergies, which are cost cuts. And when that happens, that's when the deals get a little bit harder to justify. And down the road, those are the ones that run into problems. So I think it's really hard to look at it and say this is going to be great for shareholders. On the other hand, I think, in a time when it's so hard to come by growth and these companies don't really have a whole lot of other options and everyone is merging, it makes sense to do it. And, maybe the scale of it, and maybe they'll be able to offer some packages that are more appealing to customers. Maybe they can bundle the wireline and the wireless assets, and maybe that just makes a better offering and down the road somehow creates value. But I always go back to the numbers, and it's just really hard to make it work at first. So it's going to be interesting to see if this does come together, which we don't know if it will, but if it does, it'll be interesting to see how the terms play out and if they can even get to that point. I mean, even just looking at the stock prices today, Charter trades at a much higher multiple than Verizon does. So that's tricky when you have the buyer has a cheaper stock than the target.
Fascinating piece, great analysis of it as well. Bloomberg Gadfly's Tara LaChapelle, thank you for your time. Now, a story we're watching. Airbnb has hit a new milestone. The company turned a profit for the first time during the second half of 2016. This, according to people close to the company. And the rental company believes it will maintain profitability in 2017, excluding certain costs like taxes. Coming up, we'll speak with Brian Ruder, his partner at Permira, a huge player in the PE world. We'll ask him where the firm is looking to invest. This is Bloomberg. It's about to get cheaper to ride a Lyft. The number 2 US ride-hailing company plans to cut prices 1% to attract more customers. It will also increase the number of cities it covers to 300 from 200 by the end of 2017. Neither Lyft nor top rival Uber are making money in the US as they compete for driver and rider loyalty. Now, while the tech IPO market has slowed down, private equity activity exploded in the last year. According to a report from Piecyk, the technology sector received more investments from private equity firms in 2016 than it did in any time in the past 15 years. All told, 567 deals worth $159.8 billion were completed. So what's ahead for 2017? I'm now joined by Brian Ruder, partner and co-head of the technology team at Permira. They're one of the biggest players in the space and currently own 2 of the largest private software companies in Silicon Valley, Informatica and Genesis. Thank you for joining us, Brian. And I know you well, I know Permira well from European days, but I want to know, if 2016 was so hot, competition is fierce, we've got valuations arguably pretty high. Have your tactics, the way in which you deploy your investment, I know you aim for growth, is that changing at all?
It's really not. We've been pursuing the same strategy for the last 30 years, which is really twofold. Pursuing wonderful growth companies, so above market growth businesses. Tech is a really core part of that. Not all of our competitors really pursue that strategy. Many of them are pursuing more of a cut costs and kind of run the business out. Yes, it's a fantastic way to make money. We just have a very different strategy. And the other one is really to look for international businesses. So you know us from Europe. We were headquartered in Europe in our early days, and we're headquartered there today. We've really expanded to be a global operation. We have 14 investing offices around the world. Roughly 100 investment professionals, 25 of those come from different nationalities. So we believe in being very much in the local markets in which we play. So a lot of what you're saying in terms of the increasing competitiveness you've seen in the US market for sure, that's been driven by a number of factors, one of which is the availability of leverage, valuations on the rise, but really that tech and software in particular, which is a core part of where we've invested, has been such a successful area over the last 15 years. I mean, it really went from almost no deployments in the early 2000s. People used to think you couldn't do a leveraged buyout of a software company, to being both one of the most successful areas in capital deployment and very importantly in returns. So we expect that to keep going, and more companies are falling within the lens of acquirability for the private equity industry. So although lots of capital in and lots of deal making, we think it's going to continue to accelerate.
I want to focus in on one of your deals, Informatica, which you bought. And I thought it was interesting because it wasn't just a private equity-led deal. You actually got some tech giants to come in on with you. There's Salesforce, Microsoft joined you, and it was the Canada Pensions Plan, I believe. How is it working with other tech giants when you are growing such a business, and how is Informatica growing?
Yeah, and of course I can't speak for Salesforce Ventures and Microsoft, who've been great partners with us in that investment, but we think that's a great sign that private equity can coexist very collaboratively with the large tech titans as they go through their various M&A strategies and kind of in and out. And Informatica, which is a fantastic business, it's a leader in the data integration space and has been, really pioneered that space over the last 10, 15 years. That's very much a growth investment for us. And we think, although I can't speak for them, that Microsoft and Salesforce Ventures joining us in that investment is a sign that they also believe that that company continue to be a really exciting grower for quite some time to come.
When you look at growth, do you have levels that you feel you wouldn't get in unless you could drive it up by a certain percentage, by a certain doubling, tripling?
Yeah, there's a really good range for us, which is above market by a significant majority, but below the range where the IPO market has become a really exciting place to go. That tends to be kind of in the 10 to 20% revenue growth range. Underserved is not an exciting level to grow at for a public market. It tends to be way too expensive for, I'd say, the private equity players that are looking to pay single-digit multiples for pretty much everything. So that's been a really rich area for us, 10 to 20%.
What about the M&A that just been talking about Charter and Verizon? We know that Verizon's looking at Yahoo, you've got AT&T looking at Time Warner. These companies, if they manage to merge, would have to probably spin off a few areas of the business if they went through regulatory hurdles. Is this an area of rich pickings right now?
It will be an area of rich pickings. We usually say that when you see a period of very large corporate consolidation, the year or two after that tends to be a really good time for private equity to go after carve-out transactions. So we saw that in 2012 when we carved Genesis. You mentioned that as one of the largest private software companies in the valley here. Genesis was previously owned by Alcatel-Lucent. And post those kind of combinations, you really see some of those non-core assets coming out, and a lot of times they're really high-quality businesses. The same can work in reverse. We bought a company called Magento in 2015. Magento was really a piece of eBay and sort of fell off the truck, if you will, in the giant $70 billion split between eBay and PayPal. So anytime there's periods of large corporate consolidation and then deconsolidation, there's usually some assets that you find just don't meet the strategic agenda, and that's a great time for us to find good companies to back.
Some of that consolidation, many have said, is down to the Trump administration. Your administration might mean yet more consolidation, maybe an easier regulatory environment. What else has the new administration brought for you? The fact that taxes might be coming down. Is there anything that changes the way the land lies that makes you think differently about the way you'll invest?
It's really hard to say. I think it's a little too early to tell, but suffice to say, along with everyone else, we'll be watching the next several months very carefully.
And very quickly, exit strategy, therefore. You say you would go for... You want to move away when IPO isn't too exciting. We just saw AppDynamics not go for an IPO. Is that something you're going to see more of?
I hope we do. I think it's really exciting that Cisco bought AppDynamics in the way that they did. We're actually pretty familiar with that playbook. Cisco actually acquired one of our software companies several years ago, a company called NDS, which similarly had filed to go public, and then Cisco swooped in between S1 filing and when we got out on the road. So it's been a playbook that's been used before, and Cisco being a software buyer, again, is a really exciting thing to see. So we think it's great to see the strategic buyers back in. Now, are they going to be competition for us on some new transactions? Yeah. Sure, they will, but AppDynamics was not something that was really a touchable company by the private equity ecosystem, even for the growth folks such as ourselves.
Wonderful to have you on the show. Thank you, Brian Ruder, partner and co-head of technology team at Permira. Now, still ahead, Tesla has popped 40% since December the 1st. So just what is behind the jump? We'll dig into the ties between CEO Elon Musk and President Donald Trump next. This is Bloomberg. Now, Tesla has sued the former program manager of its autopilot team. The electric car maker is accusing Sterling Anderson of taking confidential information and trying to recruit at least a dozen former colleagues. The car maker also alleged it's in the complaint that Anderson has been collaborating with the former head of the Google self-driving car project, Chris Urmson. Tesla is seeking a court order barring Anderson from recruiting employees. Finally, over to much of the 2016 Tesla CEO, Elon Musk faced a lot of scrutiny and skepticism over whether he could pull off his ambitious goals for the company. But since Musk has become an ally and advisor of President Trump, things have changed. Check out my Bloomberg at the moment. Musk and Trump, suddenly their matiness is paying off. 40% gain since December the 1st. That is what you're seeing in terms of the share price. We're currently seeing, as we'll notably note, we're now at 252.51. Morgan Stanley analyst Adam Jonas actually saying this is an important line of communication to Donald Trump. Many people factoring in that maybe this allegiance that we're seeing with the administration and Elon Musk is paying off and they're starting to buy into the stock. Tesla benefiting by everything being made in America. Excitement, of course, from the Model 3, acquisition of Solar City, Gigafactory. That's pumping out batteries. There's a lot to be said to be behind the slight euphoria that you're seeing in the stock price. But how much of that is down to the relationship with Donald Trump? We'll see how much that continues, just off a little bit over the last 2 trading days. Now that does it for this edition of Bloomberg Technology. Tomorrow, we're talking the business of space. This is Bloomberg.